Ugro. I welcome you all in our December quarter's earning call. Along with me, the senior management team consisting of Mr. Kishore Lodha, our CFO, Mr. Anuj Pandey, our Chief Risk Officer, Mr. Amit Pandey, our Chief Revenue Officer, and Om Sharma, our Chief Operating Officer, are also present in the call. Our investor presentation is already uploaded, and I would be referring to the same presentation in our conversation with you. Kindly refer to the slide 3 of the presentation. Over the past few quarters, we have been consistently speaking about the large addressable market opportunity for MSME and how the credit gap for them has widened post-COVID. This slide demonstrates the strong rebound by MSME post the initial dip during COVID. If you look at the left-hand side of the chart, based on the data we have gathered from applications, we see that loan sanctioned per customer average rupees 40 lakh in 2019. This number halved during the first and second wave of pandemic. However, in Q3 21, there has been a strong resumption in business activity. In the first year post-pandemic, that is in FY22, 77% MSME in Ugro's target segment experienced a business resumption. Next year, 68% of MSME saw more than 10% year-on-year growth in the turnover. This has led to increasing credit sanction per customer post-COVID as seen in the right-hand side of the chart. Over the last 3 quarters, the loan amount sanctioned per customer has averaged around rupees 90 lakh, much higher as compared to the pre-COVID. Both these charts demonstrate the resilience of the MSME sector, increasing credit flow to this sector, and the importance of timely credit for small businesses. Besides this macro trend, which gives us the confidence that building a large institution around MSME financing with power of data tech is a real possibility. Now moving to the performance of the business, please refer to slide 4. Our early OPEX and infrastructure build continues to deliver strong top line and bottom line growth. In 9 months 24, we have delivered 64% year-on-year AUM growth, while our PAT has tripled on strong operating leverage. Our return ratios have improved to 2.3% return on asset and 9.7% return on equity from 1% and 3.5% last year respectively. And our slide 5 in the presentation gives you a snapshot of other key business metrics. If you refer to the slide 6, our net disbursement stood at 1,552 crores during quarter 3 FY24. Which represents 33% year-on-year growth led by a strong growth across our prime business loans, micro-enterprises secured loans, machinery secured loans, and partnership and alliances segment. This has led to a 64% year-on-year growth in AUM, which has touched 8,364 crores, explained on slide 7. We have now reached the coveted 1 billion AUM club. This journey from 2,500 crore AUM to 8,300 crore in AUM over last 8 quarters has been an outcome of our early investment in multi-product distribution channel, deep partnership with banks and large NBFC on co-lending and co-origination, investment in Grow Score, and continuous support of our balance sheet liability providers. On slide 8, you will notice that this solid top-line growth has led to significant operating leverage, with PAT growing 8x over the same period. On slide 9, you will see that our collection efficiency continued to be stable, while GNPA and PA stood at 2% and 1.1% of total AUM, respectively. Our GNPA has increased by 0.1% quarter-on-quarter and 0.3% year-on-year basis, which is as per the plan. The increase is a function of our portfolio, which has been maturing over a period of time, and we do not see it as a credit deterioration as our collection efficiency and bounce rate data have remained stable and tracked well. We intend to cover ourselves well with respect to provision coverage ratio, and it has remained stable at 49%. As we have mentioned in the past, our liability strategy is a function of our on-balance sheet lending from diversified set of lenders, co-lending partnership with banks and NBFCs, and direct assignment with financial institutions. On next slide, you will see that our off-book share is 45% of AUM. This is as per our long-term vision of reaching 50% mix. We are seeing our relationship maturing with our bank partners, and new partners are coming on board. We believe in that next few quarters, our contribution of co-lending would gradually start inching up beyond 50% as well. On slide 13, you will see our cost of borrowing increase 4 basis points quarter on quarter. Our borrowing stands at 4,173 crores, with 43% and 10% of this mix coming from banks and NBFC respectively. DFIs, FIs, and capital markets contribute to 18, 10, and 19% respectively. So our borrowings are fairly diversified across various financial institutions. We continue to believe that the increased risk weight on banks lending to NBFC would not affect us adversely given our diversified liability strategy and less reliance on banks. On slide 14 and 16, details of our financial numbers and key ratios, and the remaining slides give an overview of the company. We will continue to believe that Ugro in coming quarters would increase its penetration, yield profile, and operating leverage. We would be happy to answer any questions now. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Darshil Pandya. Please go ahead, sir.
Hello. Hello, sir. Am I audible?
Yes, you are.
Congratulations on the good set of numbers. A couple of questions from my end. Sir, are we on track to achieve our aspirational 10,000 crore AUM by this fiscal?
Mr. Pandya, that's why you have used the term aspirational. We are striving very hard to get there, but at the current run rate, we are focused on two things. Obviously, AUM is one aspect of the business, but we are simultaneously controlling our OPEX so that we can deliver the operating leverage. So if given a choice between increasing just the AUM and reducing the profitability, we would actually do the contrarian and will maintain the profitability. I think so we will be somewhere near to that, but we don't think so that we'll get there completely at 10,000 crores.
Got it. And sir, on the slide 9 where, the GNPA, product by GNPA is given. So there I see that the prime unsecured loans contribute around 3.6% of the GNPA. So any measures that we have taken, to take it down as maybe, that because that's showing one of the...
Yeah, Anuj. So I'll take that. Hi.
Hello, sir.
So the planned GNPA number for unsecured loan, as we had been commenting on in various investor calls, is between 4.5% to 5% lifetime. And right now it is most of the portfolio, about 99% of the portfolio is post-COVID, and it is now seasoned up to about 24 months. So we are, from traction perspective, are at where we wanted to be. So we expect a lifetime NPA of around 4.5% for unsecured loans.
And annualized credit cost of around 1.5% to 2%. So the way you should look at it, and that's why we give this data, we construct the portfolio to arrive at 2% credit cost, and we want to make sure that not just the GNPA, but the total credit cost is within our tolerable range. And that's why you mix a certain percentage of portfolio which, have certain defined credit cost metrics. Actually, as Anuj said, this is as per the plan. At the 19.25% yield at a 1.5% to 2% of total credit cost on an annualized basis, we think so this is a good product for us. But obviously that's why we maintain this at, near about 30% of our total portfolio.
Got it. One final question. Have you opened any new branches this quarter? You said that, you'll be opening around 75 more branches. So what's the update on that?
So we started this around 1.5 months back. Look at the physical infrastructure rollout is a long journey of around 6 months. It has to be broken in identification, which we have identified. So we are expanding in UP, MP, and Andhra, and certain branches in our 4-5 states. Then it is identification of physical infrastructure, then people, and then it goes live. At the first 2 stages, we will be ready with 30 locations by end of this month. Operationally, we would be around 25 to 30 locations live starting business by end of the quarter. So over a period of next 2 quarters, we expect all of these branches to go live. And as you know, the micro branches takes around 12 to 15 months to get to the stage of break-even. But I should tell you this, that relative OPEX increase of the physical infrastructure has very limited impact on our overall profitability.
Got it. And sir, any guidance on the cost of borrowing?
As far as cost of borrowing is concerned, we have been able to manage the cost of borrowing at fairly reasonable level for last 4 quarters when the things were really tough. RBI will increase the rate multiple times, and on the general guidance on liquidity is not very encouraging at this point of time. Still, because of the diversity and because of our relationship with all the lenders that we have for all these 5 years of our journey, we have been fairly consistent as far as borrowing cost is concerned. It may inch up a little from here on, but we are not expecting a significant jump as far as borrowing cost is concerned.
Got it. All right, sir, I'll get back into the review. And congratulations on this great set of numbers. Look forward to the next quarter.
Thank you.
Thank you. The next question is from Avinash Singh from MK Global. Please go ahead, sir.
Yeah, hi. Good afternoon. Good set of numbers. A couple of questions. First one, if you can sort of elaborate in addition to your branch expansion plan that would be largely for, the micro enterprise loan. So what sort of, aspiration we have over the next year and beyond that to grow that, micro enterprise book, because that will be largely kept on book and of course will be accretive to the yield and all. So, what sort of, AUM target you have particularly in that segment in the micro enterprise driven by, the branch expansion part. So that will be my first question. And second, some color if you can sort of provide around some bit of a, increase in the credit cost and slight moderation. Not a QOQ, but YOY basis in terms of the regular collection efficiency. Also, some kind of a coloring what is leading to a slight increase in the credit cost and moderation in the collection efficiency. Thank you.
Yeah, I will take first one broadly. Amit can actually comment more detail. So, as you rightly said, that the micro enterprises, Avinash, is a slow burn but highly accretive business to the balance sheet. We have been in that business for almost 2.5 years, and we have now, through a very hard route, had learned how to penetrate into the most profitable but most under-penetrated business of micro enterprise segment. We now have 75 matured branches delivering roughly around 75 crore a month. And once we touch that milestone, we have committed to ourselves that first round of our 75 branches, when they will get to the 75 crore, we will do the second set of 75 branches, and that's why we started ourselves. And these branches, we expect that over a period of 12 to 14 months, would also deliver 75 crore per month basis. Incrementally, we would, as we gain the traction, we would also, continue to open, more branches, but we will have to manage it basis the operating leverage which we are promising to, investors at large, and the incremental OPEX we can take. But I think that we have to constantly invest into the business for long term while delivering the, quarter-on-quarter profitability, as per the expectation. I hope this answers the question you in some way. You want to add something, Amit?
No, so on the AUM piece at this point of time, December ending, our micro branches AUM is just crossed 1,000 crores. And from here, we will be able to, in next 1 year, more than just look at doubling this AUM with a typically average run rate over 12 months of about 100 crores. So that is what we're going to achieve, and that will be extremely profitable to the bottom line.
Anuj, on the collection efficiency, credit cost.
So the overall from our movement on year-on-year basis, we have seen additional 12 months seasoning in our unsecured loans. So the contribution of the unsecured loans GNPA in overall GNPA has gone up, as is our provisioning on that. So that is what is accounting for a little bit of increase in the GNPA as well as on the credit cost. But this was well envisaged. We have been tracking the bounce rates and collections efficiencies very minutely, and they continue to remain stable in a comfortable zone. Overall, the portfolio construct, if you recall, was 30% unsecured and 70% secured. And the weighted average, the way we have designed it, is to have a combined gross NPA at a steady state level of about 2% and a credit cost aspiration of less than 2% on a steady state level. Today we are at 1.5%. It will slightly go up in next 2-3 quarters, and then it will become stable just below 2%. I hope that answers.
Yeah. That very much answers. I mean, this stabilizing, peaking out of credit cost is what I just wanted to sort of confirm. Yes. So, a kind of a steady state 2% will be achieved, and before that will be some kind of a spike. Very much clear. Thank you.
Thank you. And the next question is from Omkar from Vasuki India Fund. Please go ahead.
Hello. Hi, sir. Congrats on the good set of results. So, just on the net interest income, so what we can see is the net interest income line item which you showed, so that has been flat over the past 3 quarters. But of course, that was, offset by the co-lending income, which came higher. So, I just wanted to know how we should look at this and try to model this in a number.
So, Omkar, as far as net interest income is concerned, as you rightly said, that it is a mix of on-book and off-book. But despite interest cost going up or cost of borrowing going up, we are able to maintain our NIM, which is encouraging. So, as we explained earlier, that with micro vertical taking some lead and with high-yielding product contributing more in next 12 months, it can expand further. But at this moment, when the interest rate cycle is on the high, cost of borrowings are increasing, and when we are able to maintain our NIMs, which we think that it is quite satisfactory at this moment. And as we increase the mix of higher yielding products, it will expand further. And it is possible that by next year we may see a reversal in this interest rate cycle by next year, and probably the softening of interest rates may start kicking in. That point of time, it will be the additional kicker for the NIMs of the company.
And also, I would add, the industry at large actually model everything on the basis of NII. But for players like us, you have to model ourselves on the basis of total income. So as we said, that if we presume of our total income, half of that is off balance sheet, and it will continue to be in that range or will go up. So the total income would continue to increase, and NII may remain flat. But finally, it is the spread which we are earning is not just the spread of interest, but the spread of fees or the interest spread which we earn on the co-lending as well.
Understood. So, there has been an increase in cost of borrowing, as you said. So, I just wanted to know that this pressure doesn't translate into co-lending spread as well. So, banks would naturally, try to curtail there as well.
No, sir. Actually, if you look at, so there are 2 parts to it. One, when the RBI increased the risk weight on banks lending to NBFC, which means their capital allocation becomes higher, which means that translates to the higher cost. That is only one part of it. Second, also, because the year-on-year growth by banks to lending to NBFC is more than 20%.
there are increase in MCLRs, of course, that increase would come upon us. So last 4-5 quarters we have not seen RBI increasing the benchmark rate, and very recently some of the banks have increased their MCLR by 5 to 10 basis points. Otherwise, last 3 to 4 quarters, benchmark rates have remained more or less stable. On credit cost, Anuj would take it.
Yeah. So what we have mentioned is that the overall credit cost traction in next few quarters, and this is from 4 to 6 quarters, in a steady state basis, is likely to be around 2% or below, and which is as per the design which we have envisaged. But we have been adding the higher yield segment already. Sachin mentioned that we have planned to add 75 new branches in micro. Out of that, 30 will become active in this quarter, and the rest in next quarter. We also have been adding a lot of infrastructure and resources to gain our retailer financing bit, which is granular supply chain business for small retailers, and have been gradually transitioning out comparatively lower yield supply chain portfolio. So this is already in process and part of plan.
Yeah, but this is not a reaction to any credit cost moderation. We have been on a long-term journey of 5 to 10 years. We have just completed our 5 year, of which we saw 2.5 years got wasted in the liquidity crisis led by DHFL, ILFS, and Yes Bank. We saw a COVID period, but we have remained on how we will build this business. And the core hypothesis would be that we will granularize, we'll use data, we'll use technology, and we'll go to the deeper market segment of customer, which is within 15 lakh to 15 crore bank. We'll design the yield and the portfolio segment wherein the total credit cost can remain in 2%, and we can deliver our 4% return on asset and 15-16% of or more of return on equity, and we are on that path.
Got it. Thank you. Thanks a lot.
Thank you. The next question is from the line of Sonal Gandhi from Centrum Broking Limited. Please go ahead.
Yeah, thank you, sir. Congrats on good set of numbers. I just wanted some clarification on how do you calculate IRR for the portfolio. So, there were certain questions on the NIMs. So just to give you some numbers, I mean, your AUM is up 10% QOQ. But if I look at interest income, that is up only 6% on a QOQ basis. Even your on-book AUM is roughly up around 10% QOQ. And the yields for the IRR that we've given on portfolio, that is up by 10 basis points. So where is the difference, or how do we calculate this portfolio yield?
So when we mention portfolio yield, it means that what is the customer IRR on the various segments of our borrowers. So 16.2, 16.3, which is the IRR we disclose. It is the customer the ROI for us on an overall basis. But when you look at on-balance sheet, it is again dependent on that how much of that various segments within secured, unsecured, micro remains on our balance sheet and how much goes into off-balance sheet. So it is not necessarily mean that whatever remains in the balance sheet would have similar impact as that of overall customer IRR. It will depend upon the mix of portfolio that remain on the balance sheet, which can be lower or higher compared to our overall IRR. So if I have to give an example, if Sanjeevani, which is a lower yielding product, if that remains higher on balance sheet, then our balance sheet interest income would be lower. Our customer IRR would remain same. Vis-a-vis if micro, which is a higher yielding product, if that remain in balance sheet, then our balance sheet interest income would go up, but then it may necessarily mean that our core lending income may be lower. So it is a mix of that.
So Sonal, if you want to really calculate and reconcile, so you should look at we give you a customer level yield, we give you gross disbursement, and on our co-lending slide, we'll also give you co-origination and co-lending. So if you combine the three, you will be able to understand that how much of total origination, how much has gone into off-balance sheeting, and how much has remained onto the balance sheet. And if you do that trending for a few quarters, you'll be able to come to a model analysis of that.
Sure. So that's helpful. Another question that I had was on micro enterprises loans. So if I look at net originations, that has gone down QOQ. So what explains that? Because I think micro enterprises has been the core focus segment for us.
Yeah, so I think the micro enterprises business, it is it is 6 crore lower than the last quarter. That is predominantly we were operating two products in micro enterprises. One was micro enterprises secured, which is the predominant large portfolio, and also we were adding micro enterprises without collateral loan. What we have realized over a period of time that, giving micro enterprises non-collateralized loan was cannibalizing our secured loan, and we have moderated that. So that if a customer comes which has an ability to offer you a collateral, if you open up a non-collateralized, then tendency was not to offer collateral, and that's why we have, in a way curtailed it down. That's why there was a moderation of 6 crore. And I think in next quarter you'll see a jump from there.
Understood. And so just one more question. So the co-origination has been going down as percentage of our off-book AUM. So basically, the share of co-lending is going up. So basically, I mean, you said it at the beginning of the call that, co-lending is something that you will be focusing on. But why is co-origination dropping? That is one. And second is the fair value gains that we are recognizing on direct assignments or on co-lending. That has increased substantially this quarter. So how should we look at that number from the modeling perspective?
Yeah. So, the co-origination has gone down for two factors. One, mainline, at least 95 to 98% of our co-origination were happening with the larger NBFCs, where we were also providing some kind of first loss cover. But with the credit guarantee scheme coming for the co-lending, and now the interest rate cap on has been increased from 18% to 21%. The adoption of business loan within the banking segment has accelerated at a very faster pace. So some of our NBFC-led co-origination has moved towards bank. And that's why you've seen drop from co-origination and has moved to the co-lending. Most of the co-origination, which has moved to the co-lending, this quarter has happened in option 2, which means that there is a fair value gain which came into the balance sheet. But I think we are making consistent effort to moderate it and take it in under option 1 and increase the volume so that it remains, same balance. As we were doing with NBFC, we will try to do it with the bank itself. I think it would take another 2 quarters to get to a stable position. You're getting more new number of partners. Banks, find it very difficult to do under option 1. The turnaround time when we land at that same time, banks' ability to do that. So banks predominantly get attracted to say, you do it on your balance sheet and then we'll take it later, while we keep saying that in order to generate capacity, you do simultaneously. All of that is going on right now. But in summary, the good thing is the banking system is now adopting all products which Ugro does. And actually that is a very healthy thing. So right from our prime secured business to prime business loan segment to machinery to our micro enterprises loan, if you look at the chart on the co-origination and co-lending, you'll see except supply chain, which is very difficult to do co-lending, and most of our products are in, co-lending segment, which means that our engine and its credibility, its origination, its credit quality within the broader banking system is now getting accepted.
Understood. So just one last question from my end. So if you could run us through credit cost product-wise, I mean, on a mature basis, what kind of credit cost product-wise do you estimate or do you expect?
So on a mature basis, from credit cost perspective, although in the investment slides we have given a GNPA number and not the credit cost number. So I'll start with the GNPA first, and then we will correlate it with the credit cost. For prime secured loans, in steady state, GNPA would be in the range of 0.5 to 0.75%. For prime unsecured loans, we expect it to be around 4.5% lifetime at a steady state basis.
So annualized would be around.
And I will also tell the annualized credit cost impact for each of those. So for prime unsecured loan, actually the credit cost percentage annualized would be less than 0.2. For unsecured loan, it would be little less than 2%. For micro enterprises, a steady state GNPA would be around between 2.5% to 3%, where the credit cost, corresponding credit cost, would be in the range of 0.75 to 1%. On supply chain, it is a little higher than expected at this point in time, but when we are transitioning towards retailer finance, and a steady state GNPA should be about 2 to 2.5%. On machinery loan, the expected GNPA on a steady state basis is between 0.75 to 1%, and the corresponding credit cost in the range of 0.2 to 0.3%. And in partnership and alliances, because we have a credit enhancement in place, we don't expect any credit cost going forward, though it can happen in rarest of rare cases.
Yeah, the only thing I would say, Sonal, that for analysts like you to model over this is a little difficult because the translation of this credit cost to our balance sheet is depending upon how much of that portfolio is held on to the balance sheet and held in co-lending and held in co-origination. So wherever you model the credit cost guidance we are giving, you should look at on balance sheet plus co-origination coming to our balance sheet, and actually no credit cost coming when it comes to the co-lending. So I think that you have to be careful. It's not a straight-through model that you do for banks and NBFCs.
Understood. But sir, when we are talking about 2% credit cost or lower than that, we are talking about AUM, right, on the AUM basis?
Yes.
Yes.
Okay. Thank you. That clarifies.
Thank you. The next question is from the line of Pruthul Shah from Anubhuti Advisors. Please go ahead.
Am I audible?
You are, sir.
Yeah, sir. So, congratulations again for good set of numbers as always. One update that the company has made recently with respect to entering into the factoring business. So, it would be good if you give some glimpse of this business, how the government platform would be used and how it would be beneficial to Ugro, and probably what would be the yields and credit costs that we are internally expecting by entering in this business. Thank you.
Thank you. I think the factoring, license, it is not an expansion of new line of activity for us. While, around 4 years back, mainline NBFCs were allowed to additionally have factoring license, and it's taken roughly around 1.5 years for us to get, and we are now a factor. What it does for us, one, obviously we are eligible to now participate on the TREDS platform, but I don't think so the NBFC like us are, competitive to play on the TREDS platform because the yield at which the invoices get discount there is predominantly for banks and very large NBFCs. But what it does, it facilitate and, improvise certain product of ours. So to give you a practical example, in our retailer financing and in our supply chain ecosystem, we do sales invoice discounting. Where sales invoice discounting means that if I'm selling honey to Dabur, I've been doing it for 5 years, and Ugro want to discount the invoice, which as a vendor to Dabur, I have, sold the material and I want to get in money against that. In today's scenario, Dabur pays back that money to me, when I'm a supplier, and then I pay back to Ugro because there is a financing against that. The risk is that if I have some other need at that point of time, when the Dabur pays to me, I will use that money for something else. Now, we convert that as a factor business, which means I assign that receivable to me under Factoring Act, and Dabur is obligated to pay that money directly to me. So I have a recourse against the vendor as well as Dabur. So some of our product actually would now be more palatable, and we should be able to grow that. How much is what we are making an assessment, but I think it is potentially giving us a regulatory cover wherein the very large need of getting working capital against invoices, we should be able to enable through this license.
Okay. And sir, like going forward, like 2-3 years or any longer term time frame, what would be the percentage that we might be having through this business?
Factoring, I think so the percentage AUM of our supply chain business is what you should look at. It should remain in the same percentage band what it is today. So our portfolio construction is a long-term strategy. 70% of our portfolio would like to be secured by some form of collateral. 30% of our portfolio we would like to do without collateral. Of that bucket of 70%, there is a certain percentage of portfolio which we will do against receivable and, other form of business. I don't think so that this changes the construction of our portfolio. We will continue to grow, in the same defined risk matrix and portfolio matrix. But I think so the credit cost, because of this, might come down by certain basis points.
Okay, got it. And sir, another question with respect to the collection. So currently, how the collection is done through from the clients? Like, is it the manual collection that we are doing, or is it ECS or NSH based? Are we getting the checks? If you can guide on that aspect, and if say some payments are automatic coming to the Ugro, then how much percentage of the money is coming to us directly, and how much is coming through this say offline or that way?
So 100% of our customers are NACH registered. Some of them are e-NACH registered. So we don't do anything manual. But in case there is a bounce, then there is a very large collection team, including a large collection call center, which follows up with the customer. And in that case, it might happen that the customer is sent a separate link through which he can pay. But that also, about 90% of that collection is also electronic. In far and few cases, the customer sometimes opt for a cash collection. We don't encourage it, but sometimes it is part of the game, and hence we take it. But broadly, we are into a automated collection.
So, sir, 99.999% of our collection is digitized, is directly to the customer's bank account, is the summary of the answer. And we follow the behavioral aspect of MSME is that at the point of repayment when we hit their account, sometimes they don't maintain balances because they may be using this cash for their other working capital needs. And that's why you have to have a process of a rigorous follow-up and remind them of, importance of paying it timely. And once you do that, that's when the, money comes back very, very quickly to us.
Okay. Got it, sir. Thank you so much.
The next question is from the line of Yash Darvi from Systematics. Please go ahead.
Yeah, congratulations, sir, on great set of numbers. So our target was to take the off-book AUM to around 50%. So when can we expect to achieve this?
See, that target was defined for the next year. But as I said in my opening remark, that we are seeing this, as a counterbalancing to liquidity, which might get a little bit slowed down from the banking system to NBFC. But given our underlying asset class, which is MSME, priority sector, highly granular, and certain new bank partners coming to us when getting onboarded, this we might achieve it much faster and probably go beyond 50% as well in next coming few quarters.
Okay, sir, got it. And sir, regarding our portfolio yields, it has been stable around 16.3% net yields for the past 3 quarters. So will it be in that range, or it may increase going ahead?
So with increased contribution from our new branches of micro enterprises and retailer finance, it is likely to go up. Amit, you want to add?
So, like Anuj explained earlier also, the focus has been introduction of these products now that we have a significant reach with our branches and with our new branches that are opening. The retailer finance business and the micro enterprises business will help us increase these yields. These yields will start inching up quarter on quarter. By next year end, we should see about 75 to 100 basis points yield increase across the AUM.
Okay, sir, got it.
Thank you. The next question is from the line of Anil Tulsiram from Contrarian Value Edge. Please go ahead.
Yeah, thank you for the opportunity. Sir, my question is regarding the underwriting process on micro loans. So what I'm trying to understand is, if I look at the affordable housing players which are operating under 10-15 lakhs, so most of the players, in fact majority of the players in the past have suffered from high NPAs once they scaled up beyond 5,000, 6,000 crores. So how our underwriting process is different, or what we have learned from them to ensure that we don't face the same problem? So that is the question. Mainly on the underwriting process, selection of the customers, geographies, collateral, all those things. Thank you.
Sir, predominantly housing finance company, whether the prime housing finance company like of the SDFCs and other, or affordable housing finance company, are evaluators of collateral. So they rely on collateral first and repayment ability second. We rely on repayment ability first. Collateral is the second defense to recover our money in case of a default. So I think so their two businesses are not comparable, not parallel. We lend to businesses, we assess their cash flow, we look at their repayment ability, and whether that is done by a machine or in case of micro enterprises through a very rigorous process of a templated underwriting. And once our system on people are comfortable that the customer during the defined period has the visible cash flow to pay back the interest plus principal, then only we lend. But for the minute or percentage of people who will go in default, we take collateral to recover our money. So I think so that's the answer. Anuj, you want to add something to that?
I think that's enough. I mean, the point is that a lot of analysis and investment is made to understand the customer's business in real, unlike a typical housing loan, and that is why the numbers will be very different in future.
Yeah, and I have a request also, maybe this quarter or next quarter, whenever you find feasible, can you add some slides on the micro loan book so that we can understand more how the customers are selected, geographies are selected, the organization structure, number of staff? Means there are lots of questions which may not be possible to ask in the call, but if you can provide some slides, that will be very helpful.
We would try to do that, but Manoj, the difficulty or the challenge is that most of our peer set are in only one segment or two segments. So somebody does only high ticket lab, somebody only does MFI, somebody does. When it comes to the MSME financing, we have taken this enormous task to ourselves to solve the problem of credit, and that we are doing through multiple modes, right? So so micro in itself is a business which has multiple metrics. So as our supply chain, so as machinery, so as this. So we have been getting this constant feedback that your investor presentation are very large and elaborate, and we should focus on more key return metrics and deliverables, because that's what market monitor you. And whenever anyone has a more detailed question in trying to understand the segment, we are happy to do that. But we take your point and we'll see that how in some of our slides we give more data around each of our segment, not just micro.
Okay, and sir, the last question is, I think 6 months or 1 year back, RBI allowed NBFC to do eKYC through some KUA route something. So have you already registered for this license, or we are planning to register this?
So we have registered for this license, and we are in the process of implementing this internally, and that will help us achieve some efficiencies in terms of the KYC as we go along.
Okay, thanks. That's it, sir. That's it from my side.
The next question is from the line of Surbhit from Trade Swift Broking Private Limited. Please go ahead.
Okay, I just need a little clarification about something which you have said earlier in the call. Hello. Hello. Hello.
Line has been disconnected. We will move to the next question.
Ladies and gentlemen, stay connected while we reconnect the management line. Management line is reconnected. Please go ahead.
Yeah, I think there was a question being asked from Trade Swift. Sorry, we got disconnected. Please go ahead. Hello.
Mr. Surjeet, your line has been unmuted. Please go ahead with your question.
Am I audible now?
Yes, you are.
Yes, sir. I just need a little clarification about something which you have said earlier in today's call. I think I might have misheard the same, that you said that you have 75 branches as of right now and you are expecting to do 75 crore of business from each branch.
No, sir. I wish, हमारे कहते हैं आपके मुंह में घी शक्कर. 75 crore from 75 micro enterprises branches right now.
Okay. Now I hear about this. Thank you.
But I wish what you said come true and sometimes.
Yeah, that's what I wish to. That's all from my side.
Thank you.
The next question is from the line of Nitin Gupta. Please go ahead.
Thank you for the opportunity. Am I audible?
Yes, you are, Nitin.
Yes. So, Mr. Nath, I have a couple of questions. There was some problem on the line, so I'm not sure if you have answered them already. The first one is, are you on track on your guidance of 3% ROA by 24 end and 4% by 25 end financial year? And same thing goes for ROE.
So we are on track as far as this year's guidance on ROAs are concerned. This year we are fairly confident that whatever we have guided on ROEs and ROEs, we should be almost there, some basis point here and there. Next year we are again on the drawing board for making our next year's plan. So 30 to 45 days we will be clearer in our mind that where we will be. But the path is directionally we are moving towards that.
And as I have to keep saying that, look, we believe that we are in the journey of making an institution. Our capital structure is institution. Our governance structure is independent. And this is led by an entrepreneurial management team which want to deliver an MSME financing institution in India. And on that path, we believe that the best financial services and lending company deliver three, four things. Steady state growth rate of 30% and above, and ROA between 3.5% to 4%, and ROA of 18% and above, credit cost below 2%. Only difference that most of the lending companies deliver this ROA on leverage of 6 to 7, where we will deliver this ROA at leverage of 3.5 to 4 because we have this model of off-balance sheet business. And I think that we are continuing on that path. We think that our investors, current, prospective, and public market would continue to benefit from this conviction of ours that we can deliver an institution. Some degree of variation in some quarters, in some years, do not deter us from our long-term goal of delivering an institution to you.
Okay. The second question which I wanted to ask is with respect to the AUM. So I have learned, in the previous calls that I have attended, I have learned that you were saying it to be roughly 9.5 to 10K by 24 end and around 18 to 20K by 25 end. So even the lower end seems far-fetched right now. Because the one point which I want to really emphasize here is we achieved the AUM of around 1K in the Q4 of financial year 23. But we haven't been able to achieve it any of the quarters in this financial year.
Sorry, can you repeat the question?
I'm saying, what about the guidance with respect to the AUM? Because as per what I am observing from the past few quarters, the guidance which have been given, I don't think even the lower end we will be able to achieve it. And to give an example, like we have not been able to achieve a quarterly AUM growth of 1,000K, which was delivered in the Q4 of financial year 23.
Yeah. No, this is a fair question. And this, I think, this I've been saying for long. You know, as institutional builder, we put ourselves and we don't differentiate of what we say in the market and what we, say to our board and what we say to ourselves. We would like to be the largest financial institution around MSME financing, and we put milestones behind that. So we have put a milestone of 10,000 crore, then 20,000 crore, then 30,000 crore, then 50,000 odd crore. Now, and also simultaneously to reward the shareholder and shareholder benefit from that, we have to deliver the end bottom line profitability. If you're a public market investor and if you have to, gain from investing in our stock, then it is just not the function of the top line growth or AUM growth, but it is also comparable delivery of the bottom line performance. So we make that adjustment between AUM growth to bottom line performance, and that's why that there is always a little bit of a degree of variation come. What we have said, we exited March 23 at a 550 crore gross run rate. We said that we will not invest in further OPEX. We would deliver, 550 crore on a monthly basis. And this is that math, and what would be the end of the year, we should reach, we aspire to be at 10,000 crore. But simultaneously, we also make promise to deliver certain bottom line performance. So depending upon the liquidity, depending upon the flow, depending upon the credit cost, depending upon the arbitrage between AUM to the profitability, the business automatically get recalibrated, and I'm hopeful all of you would reward. If you look at in our peer lending segment, there is no company, and I repeat, there is no company which has been able to triple its AUM in a most difficult time in 3 years. It has tripled its profitability, and it is still promising to do it in a same way. So our heavy investment in OPEX technology and data is delivering to desired results. While some of the investors may just monitor us on the basis of one number, some of them will look at a combination of all three. But we will get there, what we have said. It may be just delayed by a quarter sometime, and it may be get accelerated also by a quarter sometime.
So, how are you planning to do it in the coming financial year? I'm not asking about the numbers, but are we having the enough infrastructure in the form of the branches, the touch points that financial year 25 will do some monthly, we must be having some monthly targets or quarterly targets. So, have we laid down the enough infrastructure to basically achieve it?
So, sir, we are delivering 550 crore of gross disbursement. Our AUM...
I'm talking about the coming financial year, sorry.
I'm coming to that, sir. So, we are delivering 500 crore of gross disbursement. Then there is repayment, there is foreclosure, and that comes to the net AUM increase. Now, we've said that we are adding 75 more locations. Technically, we should be adding 200 more locations, given that we have strong, under penetration, which is in a micro enterprise segment. But that's the arbitrage between how much OPEX we can take versus just the AUM growth. So that incremental 75 branches, our focus on the increased penetration of retailer financing, we are hoping that from current 550 crore, we hit the benchmark of 750 crore per month and then 1,000 crore per month, so that we can get back to near to what, we aspire to be in next financial year, end of financial year. Only caveat being, it is also a function of overall liquidity into the market. We are feeling very confident that given the number of bank partnership which we have, our ability to do co-lend, our diversified lending book, we would be there near to that, but we will also calibrate between just AUM growth to the profitability, and we'll try to deliver both of it.
Okay.
Does that answers your question?
Yeah.
Okay, fine, yeah.
Okay. Ladies and gentlemen, please press star and 1 to ask question. The next question is from the line of Omkar from Vasuki India Fund. Please go ahead.
Yes, sir. Sorry, I got dropped off last time.
So, on the net loan origination, I was looking at your mix for the last few quarters. So the prime secured disbursements have been coming down. It was 360 in Q4, and currently it is around 250. And unsecured has been growing at a faster pace from 400 odd crores to 600 in this quarter. So how do we see this mix going ahead? Is this our steady state mix of originations?
So very, very well. That's a good question. That why has secured come down over the last 2 quarters? So we had 2 products in secured. If you've been following us, one was the prime secured, and one was the affordable loan against property, or the affordable LAP called Sathi. Now that you would have heard that our one of our fundamental pillars for the long-term loans, so that the long-term loans do not stay on our books, is co-lending. The affordable loan against property was typically a loan which is done on the periphery of the large cities, where the collateral may be not as prime as the collateral in the prime loans, where we also saw some resistance by some of the co-lending partners to onboard this collateral. So in view of 2 things: one, wanting to generate our secured long tenor business for co-lenders; second, to ensure that our ALM on the on-book ALM remains does not get stranded by these long-term loans. We decided to actually scale down that part of our secured. What we are currently booking is the prime secured, and from here, this prime secured will continue to inch up quarter on quarter and come back to those 360 levels, but hopefully in this quarter itself.
If I may add to that, the way we look at is not by product but overall portfolio. Our philosophy is that overall we will try to have 70% portfolio in secured, and wherever there is an opportunity, lower yielding segment would converge to higher yielding segment. So our secured business is not just that what segment which you are saying. Our micro enterprises is also secured. Our machinery is also secured. Our retailer financing have cash flow attached to that. So now we have been balancing that, doing a 12% yield business, half of that which remains on our balance sheet, versus doing higher yielding business which also have the capacity to go back to the banking co-lending system. What should we do? So this is a planned transition of gradually happening. The way you should monitor us is on the blended portfolio of 70% remaining secured, and that's why as we gradually little bit taper down the low yielding portfolio to high yielding but secured portfolio, our overall portfolio yield also would increase. So if you would have missed, we said that by end of FY25 we expect our portfolio yield to go up by 70 basis point to 100 basis points, and this is happening because of this gradual everyday transition which we do.
Okay, understood. And micro loans, is it entirely secured, or what is the mix there?
Yeah, majority of it is entirely secured. We had a non-collateralized loan product, but it was cannibalizing our secured volume, so we are tapering it down, and it's negligible right now.
Okay, and what is the security in this case? Is it residential property or commercial?
Residential commercial properties, are the collateral.
Okay. And another question, any update on the fundraise?
Right now, no. I think so. We have multiple transactions on the debt side which are going on. We have just completed this financial year. We are seeing, I think so we are well capitalized. Capital adequacy is quite appropriate. But we would, once our silent period is over, we will see and calibrate with our board that what is the appropriate time. We already have an approval of 500 odd crore. The timing of that is yet to be decided. I think we have still a lot of capital buffers. So we like to mature our business before we actually hit the market.
Okay, understood. Thanks.
Thank you. Ladies and gentlemen, that was the last question for today. I now hand the conference over to management for closing comments.
Thank you very much. If you have any further questions or queries, please feel to reach out to our investor relation head, Sneha, or write to us. We also have an investor bot. Please feel free to make use of it. All of the investor relation information can be also fed through our bot. And we are happy to engage on quarterly result and continuously as and when required. And wish you all a very good evening. Thank you.